Hey everyone, and welcome to this explainer. For the last couple of centuries, one single question has pretty much shaped the fate of nations, the price of everyday goods, and the balance of global power. Today, we're dissecting the exact state of the world's largest economy in mid-2026, and the picture is far more complex than the headlines might suggest. So let's dive right into this.
Just three simple words, right? How is America doing? Well, the signals we're getting right now are, honestly, intensely mixed. What's happening on the trading floor is completely detached from the daily reality at the kitchen table.
And really, that's the central tension of the 2026 economy. We are seeing a profound collision between macroeconomic resilience, this massive expansion you see in official reports, and household fragility, hiding right there in the fine print. So how do we actually make sense of all this?
Let's start by looking at the growth on the surface.
Plus 2.1%. That is the real GDP growth figure for the first quarter of 2026. Now, after a period where a lot of folks feared the economy was just going to stall out completely, this number suggests the engine of the United States economy is still humming along with some surprising power.
If we look at the trajectory, the final months of 2025 saw a near stall at just 0.5% growth. But then, a sharp rebound. The catalyst for that was a massive surge in business investment, topping 10%, and fueled almost entirely by artificial intelligence. This huge build-out of AI infrastructure is basically acting as the structural skeleton of this new growth.
But if you strip away that corporate tech boom, things look a bit different. Consumer spending growth actually dropped from 2.7% in 2025 down to a projected 2.1% in 2026. So while the AI sector is absolutely exploding, the everyday consumer is actively slowing down. Their purchasing power is being squeezed tight.
Which brings us to the labor market shift.
The whole texture of the labor market has fundamentally changed. Job openings are falling drastically, and downward payroll revisions show the U.S. has actually been shedding jobs since April 2025. And get this, while nominal wages went up 3.5%, real wage growth, after factoring in the actual cost of living, was a microscopic 0.3%. Inflation literally ate almost every penny of those raises.
Adding to this pressure is a massive reduction in the labor supply. Deliberate policy choices to restrict immigration have severely limited the number of new workforce entrants. By removing what has historically been a crucial labor pool, we're now measuring heavy, quantifiable strains across the service industry, construction timelines, and healthcare capacity.
Next up, we need to talk about tariffs, prices, and the Fed. Customs duties as a share of the GDP more than doubled in 2026, jumping from 0.6% up to 1.3%. Now, while the stated goal here was reshoring American manufacturing, the immediate macroeconomic consequence is basically a direct border tax. It's essentially a premium paid on imported appliances, electronics, and auto parts, and that is keeping consumer inflation stubbornly high. That stubbornly high inflation colliding head-on with weakening labor demand creates the exact scenario the Federal Reserve is desperate to avoid: stagflation. Balancing their dual mandate of price stability and maximum employment was already incredibly tough, but the current data makes it a real tightrope walk for sure.
Now let's turn to a massive systemic issue: America's trillion-dollar debt.
$2 trillion. That is the projected federal deficit for the 2026 fiscal year alone. Borrowing at this astronomical level was once strictly reserved for world wars or absolute economic collapses, but today, it has quietly just become the baseline normal.
And the downstream consequence of all that borrowing is a $1 trillion annual interest payment. That's just to service the debt we already have. Think about that for a second. We've crossed a threshold where servicing yesterday's borrowing now costs the United States more than the entire national defense budget.
To put that into perspective, back in 1946, right after World War II, the U.S. hit its historic peak of debt relative to the economy. Today, at 101% debt to GDP, we are standing right on the very edge of that record. And the projection for just 10 years from now, 120%. It's a trajectory that completely shatters the post-war record, and we're doing it entirely in peacetime.
Unsurprisingly, the global community is watching this very closely. In April of 2026, the IMF explicitly warned that America's debt trajectory is a growing financial stability tail risk for the U.S. and for the global economy. When you get a direct warning like that from the IMF about the holder of the world's reserve currency, it really underscores the immense systemic stakes involved. So that brings us to two Americas and one crossroads. The U.S. economy in 2026 really isn't a single story at all. It's more like a booming technological engine, leading the entire world in AI dominance and top-line growth, that's been bolted on to a highly fragile fiscal foundation of exploding national debt, persistent inflation, and a flattened middle class.
There's a saying that history does not grade economies on their intentions. It grades them on their outcomes. The window to correct this fiscal trajectory is absolutely still open. But as we look at the hard data driving our world today, the ultimate question remains: does America have the political courage and collective will to make those hard choices before the window closes? Thanks so much for joining me for this explainer, and I hope it gave you plenty to think about.